Welcome to the Freedom Capital Management Strategies Quarterly Market Review and Outlook. I'm Brian Zabor, Investments Director. I'm here with Pete Murphy, Chief Investment Officer. Pete, what we saw in the third quarter, equity markets were strong across the board, building on the first half of the year's gains. That occurred despite a politically charged environment. We saw geopolitical risks continue with Gaza and Ukraine, and we also saw some uncertainty with tariffs. Could you take us through what stood out to you in the markets?
Absolutely, Brian, and thank you all for joining us again. Brian said it well. The third quarter was a really strong period for financial markets. Pretty much every major market, whether it was stocks, it was fixed income, it was commodities, had a pretty strong quarter. And it was despite a lot of the headlines that Brian spoke about around geopolitical risk, around tariff uncertainty. In addition to what has historically been a seasonally weak time of the year from a calendar year perspective, the late summer, early fall tends to be the weakest period historically for markets, and it just was not so this year, with a great period of returns for stock markets in particular, but financial markets en masse. Really good third quarter. A few things stood out in the context of the quarter that were very important developments. The first was we saw a broadening of participation in the gains in U.S. stock markets, with small cap stocks putting in a very strong quarter and outperforming their large cap brethren. This was after the first half of the year where small cap stocks were very weak and significant underperformers. And to see the U.S. equity markets broaden out in terms of participation in the gains is a very positive development for investors and a really good trend coming into the end of the year. The second notable trend in the third quarter was continued strength in the large U.S. technology leaders, popularly referred to as the Magnificent Seven. These are companies like NVIDIA, Amazon, Meta, Google, that continued to generate strong earnings and strong stock price gains. And given the large size of these companies, many of which have multi-trillion-dollar market caps at this point, when those stocks do well, it tends to pull the broader stock market indices higher. And that happened yet again in the third quarter, creating a really positive environment overall for U.S. stock market investors.
Hey, thanks for those perspectives on the U.S. Equity markets. What about the bond market? How did that perform?
Yeah, great question, Brian. While it doesn't get the same degree of headline attention that the stock markets do, the bond markets are incredibly important. And bond markets put in another solid quarter in the third quarter of this year. They're now sitting on pretty good gains through the first 3 quarters of the year, not keeping pace with equity markets, but that's to be expected in a very strong equity market environment. But it's been a good period for bond investors, and a few notable trends that took place during the quarter. The first is that interest rate volatility declined materially. And that was an important development because in the first half of the year, bond investors were really beset by this elevated level of volatility and some wide movements in interest rates that caused some consternation or indigestion in bond markets. That really settled down in the third quarter and set bond markets up to put in some strong returns. The second development is that the Federal Reserve finally implemented their long-awaited interest rate cut. It had been over a year since they last cut rates, and they'd been on this extended pause due to concerns about a potential reacceleration in inflation, and also concerns about how tariff policy would impact inflation. And they've grown confident enough that inflation is contained, and they want to put some additional support to the U.S. economy by cutting interest rates. So they began that in September and are expected to continue to do so through the fourth quarter of this year. So another positive development for bond markets and financial markets more broadly.
Pete, thank you for those perspectives on the fixed income market. Turning to the economy, the economy has been pretty resilient despite all of these headlines regarding tariffs, geopolitical issues, the political issues. What were some of the key drivers and how is this occurring?
Yeah, this has been a story now for a couple of years where there's been widespread call or cause for alarm that the U.S. economy is set to slip up, that recession is inevitable. It first happened in 2022 when interest rates sharply rose due to inflation and the economy just worked its way through it. Then there was a ton of concern around how tariff policy is going to impact economic growth. And we just haven't seen a significant impact. And the U.S. economy continues to grow, continues to move forward. So when we look at the first half of the year, the U.S. economy, as measured by gross domestic product or GDP, grew at an annualized rate of about 1.4%. Now that's a bit slower than last year, but that was to be expected. But it's stronger than many economists had expected coming into this year because of the potential impact of tariffs. And when we look under the hood, What's driving this continued resilience in U.S. economic growth are two primary things. First and foremost is a resilient U.S. consumer. As we've talked about in the past, consumption comprises almost 70% of economic activity in the U.S., and the U.S. consumer continues to spend, especially at the higher end of the income spectrum. Asset prices are elevated, the job market is relatively healthy, and spending in that segment of the population remains very strong, which has an outsized impact on consumer spending. The second area that has buoyed economic growth in the U.S. is this increase in business investment on all sorts of infrastructure related to the build out of artificial intelligence or AI. That has also turbocharged economic growth from an investment standpoint, and this AI build out seems like it has more room to run because there's a significant need for investment, and there's big companies that are pouring many billions of dollars into this infrastructure build out, which is accelerating economic growth.
Thank you for those perspectives, Pete. Now, as you look forward, do you see some risks or what are areas of concern?
Yeah, for investors, there's always risks present. That is the norm. And given all the cross currents today, there are certainly risks that we feel investors should be mindful of. The most notable one today is actually one that probably doesn't get the most attention, but we do think it's one of the most important things for investors to be aware of. And that focuses around valuations. Today, U.S. stock markets sit at very historically elevated levels of valuation. And that suggests that at current prices, stock markets, especially in the U.S., aren't offering a significant margin of safety. And why that matters is if the circumstances change, if the economy begins to slow down, if corporate earnings begin to weaken, there's not a whole lot of wiggle room or cushion for markets to absorb that, which suggests that they would likely reprice lower and maybe sharply so. So it's not a prediction that that's going to happen. The economy and corporate earnings continue to chug along as they have the last couple of years, but it's something for investors to be mindful of, that valuations today are certainly more elevated than they have been historically. And for long-term investors, the starting point of valuation matters. So when you start at more elevated valuations, long-term expected returns are generally lower from a historical basis, and that's where we sit today. The second important thing from a risk standpoint for investors to note is around the job market. So the job market has been cooling. The pace of job growth has slowed materially this year, and we recently got a significant revision lower in the number of jobs that were created in the U.S. economy over the past year. So most are characterizing the current job market as a low hire, low fire environment. And what that means is the pace of new jobs being created has slowed materially and is not growing much. But what we're not seeing at this point is a significant degree of layoffs. So the unemployment rate has still stayed relatively low. So this set of circumstances, while it's not ideal, it's still one that suggests that the economy can continue to grow, that most people who want a job still have a job. But what many investors are beginning to be more concerned about is, are increased layoffs the next shoe to drop? And will we start to see an impact from that in the economy in the fourth quarter and heading into the new year? This answer to that is yet to be told, but we are trending more and closer to that direction, so it's got investors on an elevated watch for that.
Pete, those are important points. Let's pivot to the U.S. government and the spending, and is this sustainable?
Yeah, it's a great question, Brian. So this has been a topic that has been in the headlines on and off for years and decades at this point. We've seen a continued expansion in the U.S. fiscal deficit. We've seen continued growth in the level of U.S. government debt to levels that are historically high, on par with wartime going back 50 plus years at this point. And the question is, when is the deficit too big and when are the debt levels too high? And financial markets will ultimately answer that question, but what is clear and what most agree with is the path is unsustainable. What no one has known or been able to answer yet is when will that unsustainable path cause problems for the economy and financial markets. So far it hasn't, but there's some signals that markets may be waking up to this risk. A couple notable data points. One is gold, which historically is a safe haven asset, has had an exceptionally strong year. It's up over 45% through the first 3 quarters of the year. And that's in a market where stocks are doing exceptionally well, where bonds are doing well, and where the economy is growing. That's not typically an environment where you see gold doing well as more of a conservative safe haven asset, and it suggests there may be another story at play with gold. And then on the flip side, but related to this, is the US dollar has declined materially this year, and the US dollar index, or DXY, has declined by nearly 10% relative to a basket of other major global currencies around the world. So we're seeing a weakening dollar, which may suggest, when combined with the strength in gold prices, that investors are becoming more concerned with the trajectory of the US fiscal path, the sustainability of the dollar, and some of the debt dynamics at play. So nothing is breaking at this point, but there's just some indications that markets may be waking up to this risk again.
Okay, thanks for those insights. Is there anything you'd like to leave investors with?
Absolutely. So as we always talk about, there's a lot of cross currents taking place in the global economy and capital markets, and that is the norm. So to not have newsworthy events, to not have risks present would be unusual. And so we continue to advocate that investors don't try to time markets. Despite many negative headlines coming into this year around tariffs, around geopolitics, around domestic politics, what we've seen is financial markets have continued to grind higher. The economy's been resilient, corporate earnings have been strong, and it doesn't mean they'll continue that way forever. But the point being is trying to time these cycles has been incredibly difficult historically, and we don't advocate investors trying to do it. So staying disciplined, staying focused on a long-term plan is the most important thing for successful long-term investing. The second point I'd make is that diversification is very important. I spoke about how elevated valuations have become in equity markets at large, but especially in the US, and how concentrated many of the equity market indices have become, with a few large technology companies representing a larger and larger portion of those indexes. So should there be challenges in some of those companies, and should the market environment and macro environment shift, having a more diversified portfolio is going to likely serve investors well. And that's diversification in different asset classes, it's diversification in different equity markets, both geographically and in terms of size of company. But having a more diversified portfolio should add resilience should the environment turn to a less rosy place. And then the final thing is, it's important for investors to stay engaged with your financial advisor and to make your plan a living plan.
Pete, thanks for those insights. Thank you for joining us today. We look forward to updating you on financial and economic markets in early 2026.
Thank you.